Have you ever felt the rush of excitement when you first dip your toes into the world of investing? That thrill of potential profits, the dream of financial freedom? But wait, before you dive in head first, there's something you need to know. Many new investors make costly mistakes that can derail their financial journey before it even begins. But don't worry, we've got you covered. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. Many beginners lose money early on because they rush in without understanding the basics of markets. Excitement often replaces preparation, leading to costly errors. But here's the thing: the right mindset, patience, discipline, and willingness to learn is just as important as capital. Financial education lays the foundation for long-term success, and that's exactly what we're here to provide. Let's dive into the first common mistake new investors make: chasing quick profits. It's tempting, isn't it? You hear about a hot tip or see a cryptocurrency skyrocketing, and suddenly you're convinced you've found the key to overnight riches. But this short-term impulse-driven approach usually leads to losses. Why? Because hype fades and prices drop just as quickly as they rose. The truth is, long-term strategies like buying quality companies or index funds typically outperform these get-rich-quick schemes. Wealth grows steadily over time with the magic of compounding, not through risky gambles. Next up is a mistake that can sink even the most promising portfolio: lack of diversification. Putting all your eggs in one basket, whether it's a single stock, coin, or property, magnifies your risk. If that one investment fails, you could lose everything. Diversification is like a safety net, spreading your risk across different industries, asset classes, and even regions. It protects your portfolio from sudden shocks that could devastate a concentrated investment. But remember, balance is key. You don't want to over-diversify and dilute your returns, but you do want to ensure that no single asset can destroy your financial health. Now, let's talk about a trap that even experienced investors fall into: trying to time the market. Beginners often believe they can predict the perfect moment to buy low and sell high. In reality, even professionals rarely succeed at this consistently. Attempting to time the market often leads to buying at peaks and selling at lows, exactly the opposite of what you want. Instead, consider dollar-cost averaging. This strategy involves investing fixed amounts regularly, regardless of market conditions. It smooths out volatility, reduces emotional pressure, and builds wealth steadily over time. One of the most dangerous mistakes new investors make is ignoring risk management. Investing money you can't afford to lose, like rent or emergency funds, is a recipe for disaster. Without a financial safety net, one bad trade can create long-term damage to your finances and your life. That's why it's crucial to use tools like stop-loss orders, develop exit strategies, and maintain a cash reserve. These measures protect you from major setbacks and give you the peace of mind to invest confidently. Have you ever bought something just because everyone else was talking about it? That's the next pitfall we need to discuss. Following the crowd, many new investors act out of FOMO, fear of missing out, jumping on whatever bandwagon is rolling by. This herd mentality often leads to buying at inflated prices right before markets correct. To avoid this costly mistake, cultivate independent thinking. Do your own research, question popular opinions, and make decisions based on your unique financial goals and risk tolerance. Speaking of research, neglecting it is another common error that can cost you dearly. Some beginners invest without understanding the company's business model, financial health, or market outlook. The same applies to crypto projects or real estate investments. Jumping in without due diligence increases your risk of falling for scams or backing poor-performing assets. Before committing your hard-earned money, take the time to study the fundamentals. Look at earnings reports, evaluate leadership teams, assess the competitive landscape, and understand the utility of a project. Knowledge is your best defense against bad investments. Now, let's talk about something that affects us all: emotions. Emotional decision-making can wreak havoc on your investment strategy. Panic selling during market downturns locks in losses, while overconfidence in bull markets can push you into reckless bets. Emotions cloud judgment, leading to reactionary decisions instead of rational ones. Developing discipline and patience is crucial. Learn to stick to your investment plan, ride out volatility, and make decisions based on facts rather than feelings. This emotional control is often what separates successful investors from the rest. So, how can you build a smarter investment strategy and avoid these common pitfalls? Start small. Minimize your mistakes by investing modest amounts as you learn the ropes. Then, as your knowledge and confidence grow, you can scale up your investments. Invest time in continuous learning, read books, take courses, and follow credible experts in the field. Most importantly, shift your focus from short-term gambling to building long-term wealth through steady growth. Remember, investing is a marathon, not a sprint. Let's recap the key points to help you steer clear of these common mistakes. Avoid chasing hype and quick profits. Instead, focus on solid, long-term investments. Diversify your portfolio to spread risk, but don't overdo it. Resist the urge to time the market and consider dollar-cost averaging instead. Always manage your risks and never invest money you can't afford to lose. Do thorough research before making investment decisions, and don't blindly follow the crowd. Learn to control your emotions and make rational, well-informed choices. And above all, think long-term. Now, we'd love to hear from you. Have you made any of these mistakes in your investing journey? Or do you have tips to share with fellow investors? Drop your experiences and insights in the comments below. Building a community of informed investors is what we're all about here at Savvy Finance Corner. If you found this video helpful, don't forget to hit that like button and subscribe to our channel for more investing education content. Share this video with friends and family who are just starting their investment. Journey Let's S help everyone build wealth the smart way. Remember, every great investor started as a beginner. With the right knowledge and mindset, you can avoid these common pitfalls and set yourself up for long-term financial success. Until next time, keep learning, stay savvy, and happy investing.